What should I invest in? How much money should I invest? And when should I start investing? In the next two videos, we're going to answer these three questions. Hello everyone, and for those of you who don't know me, my name is Nakul Anand and I make videos on personal finance and investing. So if this content does interest you, please do subscribe and let's get started. In today's video, we're going to answer the question, what should I invest in my 20s? Now, I'm not going to beat around the bush or give you a safe answer or say something that's generic. If you watch this entire video, I'm going to tell you how you should structure your portfolio, why you should structure your portfolio in that particular manner, what to invest in your 20s, and why. Let's get started. When you ask yourself, what should I invest in? You're actually asking yourself two questions. What do I want my money to do for me, or what is my investment objective? And what should I buy to meet this investment objective? Well, in investing, there are three primary investment objectives. There's capital growth or capital appreciation, which is using your money to grow your money. There's capital preservation, which is using your money to protect your portfolio and avoid losses. And there's income generation, which is using your investments to generate income for you. Well, which is your investment objective? I normally look at the investor life cycle and I found that it's pretty accurate answering what your investor objective should be. The investor life cycle indicates the investment behavior of investors over different ages of their life. The investor life cycle breaks up your investment behavior into three stages: the accumulation stage, the preparation stage, and the retirement stage. The accumulation stage is when you're between the ages of 20 to 35. You're accumulating money for the first time. You're young, you don't have much money, you're investing for the very long term. So you should aim for capital growth by taking long-term growth-oriented risks, also known as building an aggressive portfolio. The second stage is known as the preparation stage. You're preparing for retirement. This is when you're between the ages of 35 to 60. You've grown your wealth, so you have more money at risk, but you still want to keep growing your money, but you also want to take less risk. You're investing for the medium to long term, so you should balance your portfolio by investing in a mix of investments aiming at capital growth and capital preservation, also known as building a balanced portfolio. The last stage is known as the retirement stage. It's when you're over 60 years old and you've retired. You've grown your wealth and you've earned all the money you need to earn. Now you need to protect your money and generate income to pay for your daily needs. You're investing for the short term and you need to protect your portfolio by investing in a mix of investments aiming at income generation and capital preservation, also known as building a conservative portfolio. Since today we're going to answer the question on what you should invest in your 20s, we're going to focus on the accumulation stage, which means we're going to focus on capital growth and focus on long-term growth-oriented investments. Well, what is an aggressive portfolio? An aggressive portfolio is a portfolio structure where you try to maximize the amount of returns you can get by taking a relatively higher degree of risk. Let's pause here and look at the following chart. This chart is known as the risk-return trade-off chart, and it's quite simple. What it says is if you want to get a higher potential return, you have to be willing to take a higher level of risk. Let's go through a couple of examples to explain this to you. Suppose your friend comes up to you and says, I want $100 and I'm going to start up a technology company. Well, there is a chance the technology company becomes very successful and you can make $1 billion out of it. But the chances of you losing your money are very high. On the other hand, if you take this $100 and you put it in a savings account, well, the chances of you losing money are very low, but your return is going to be very low as well. Well, which assets have a higher risk and which assets have a lower risk? Let's rate some assets from 1 to 5, 1 being very low risk and 5 being very high risk. In 1, we have cash and government bonds issued by developed market countries. If you put your money in cash or bonds issued by the US government, the chances of you losing money are very low, but you're also going to get a very low return. As we go from 1 to 2 to 3 to 4 to 5, you're going to be taking a slightly higher risk and getting a slightly higher return. In number 2, you have bonds issued by large companies such as Apple or Microsoft. In number 3, you'd have bonds issued by emerging market countries or by medium-sized companies. In number 4, you'd have stocks issued by larger companies. And in number 5, you'd have stocks issued by smaller companies and cryptocurrencies. My thoughts on this are, don't put too much of your money in risk level 1 and risk level 5. I don't want to put too much money in assets that have very low risk or assets that have very high risk. So I would put a maximum of 10% of my portfolio in risk level 1 assets and a maximum of 10% of my portfolio in risk level 5 assets. Since we're building an aggressive portfolio today, my job is to try to maximize my return by taking a relatively higher degree of risk. Well, what does that mean? That means we have to put more money in riskier assets versus less risky assets, which means we have to have a higher than 50% allocation in riskier assets and a lower than 50% allocation in lower risk assets. There's 2 ways you can do this. You can put 100% of your assets in 4 and 5 when you're 20 years old and progressively move closer to 50% as you reach 35. Or you could do something simpler and just put 75% of your assets in 4 and 5 and 25% of your assets in 1, 2, and 3 from the ages of 20 to 35. I like option 2 because it's simpler and it's easier to execute. Okay, so now we have all the information we need to structure our portfolio. Let's start off by how much we're putting in risk level 1 and risk level 5. As I already mentioned, I don't want to put more than 10% of my money in risk level 1 or risk level 5. So I'm going to keep 5 to 10% of my money in risk level 1 and 5 to 10% of my money in risk level 5. Since I know I want to have 25% of my allocation in less risky assets, that means the remaining 15 to 20% goes in risk level 2 and 3. And since I know I want 75% of my allocation in high risk assets, that means the remaining 65 to 70% goes in risk level 4. So now that we know what assets we're investing in, what investments should we buy? Well, I like buying ETFs. I've already made a video about ETFs before and I'll link it in the comment section below. But I definitely recommend you buy ETFs over individual stocks and bonds. I'm not going to go through them in detail right now because the video would become way too long and you'd probably get distracted. So I'm just going to name some ETFs that you could buy. For risk level 1, I would just keep my money in cash. I would just take my 5 to 10% and put it in a savings account somewhere. For risk level 2 and 3, I'd buy some of these corporate bond ETFs and some of these emerging market bond ETFs. For risk level 4, I'd buy the following large cap equity stocks. And for risk level 5, I'd buy the following small cap equity stocks and the following cryptocurrency. You don't have to buy all of these, you can pick and choose, but what you should focus on is that the structure of your portfolio remains the same. So there you go. I hope I answered your question on what you should invest in your 20s. In the next video, we're going to answer when should you start investing and how much money you should invest. If you did find this video helpful or useful, please do like the video, it would really help me out. Also do subscribe to this channel if you find this content useful, and I'll see you in the next one.